Longtime Tesla bull Cathie Wood predicts an impending market catastrophe as the world struggles with the Russian invasion and higher interest rates from the Federal Reserve. Considering the current situation, many investors may become panicked. But fear not. Why does Cathie Wood predict a major market crash? Has this ever occurred before? When the market crashes, how should we respond the best? To find out, keep watching. Just a few months ago, the financial markets were engulfed in one of the craziest, most reckless times ever. But the atmosphere is different now. With rising rates and significant inflation, a stock market meltdown is probably imminent. In the most recent quarterly report of ARK Invest, financial expert and CEO Cathie Wood expressed some concerns on the possibility of a U.S. recession, as well as a notable slowdown in China. In her note to investors, Wood wrote, during the next 3 to 6 months, the market is likely to focus more on the risk of recession in the United States, a serious slowdown in the Chinese and emerging market economies, and potentially a surprising drop in inflation. For what reason does Cathie Wood think the market will crash? She thinks that the market would be in a risky situation due to various risk factors. In addition to the economic slowdown in China, which Wood brought out, the United States is confronted with a number of immediate domestic economic issues. Experts suggest that in 2022, investors pay close attention to China. While China recently cut interest rates and injected liquidity into its banking system to combat slowing economic growth, the Federal Reserve of the United States is predicted to raise rates and sell assets. It is anticipated that China's economic growth would drop from 8.1% in 2021 to a meager 5.5% in 2022. China's assault on domestic tech enterprises has also hurt the country's stock market. Last but not least, the International Monetary Fund has voiced worry that China's strict zero-COVID policy is harming the nation's economy. Without a doubt, the stock market has had a difficult start to the year, and many on Wall Street anticipate that things will become much worse. This is not surprising, given the increasing geopolitical tensions brought on by both ongoing and upcoming events. As co-founder of Data Research, Nicholas Coles puts it, investors are never safe from unforeseen geopolitical developments. Despite the fact that it is challenging to predict geopolitical developments, investors have several reasons to be. President Joe Biden imposed sanctions on Russia in response to Russia's invasion of Ukraine. It's also reported that North Korea is thinking about starting up its nuclear and long-range ballistic missile testing again. Increasing hostilities between China and Taiwan may also pose a threat to international supply chains. The MSCI World Index of global stocks fell by more than sicken over the past few months, despite a robust rally in the last few days of January. This is the worst start to a year since 2008. This is equivalent to a value loss of $6 trillion. Investors are bracing for a sharp increase in interest rates from the Federal Reserve this year, and the stock market appears ready to react sharply if earnings growth disappoints. This is especially true given Facebook's disappointing performance. The post-financial crisis surge in U.S. technology equities has resulted in a loss of approximately 10% in 2022. Primary cause of market fear is obvious. After providing strong support for almost 2 years to lessen the economic impact of the COVID-19 outbreak, several central banks have felt pressured by rising inflation to tighten their policies. Interest rates are predicted to climb as trillion-dollar bond buying programs are phased out. The Bank of England raised interest rates for the second time this week, becoming the first significant central bank to do so in December. The European Central Bank hinted on Thursday that rates might be lifted in 2022, and a number of other central banks are anticipated to follow suit in the coming months. We recognize that the Federal Reserve Board will need to increase interest rates in order to fight inflation. This is probably going to impede economic expansion and raise unemployment. Maybe the Federal Reserve will strike the perfect balance and the economy will cool off without a break. Alternatively, it's possible that the worst may occur and there will be a long recession. Invest on disruptive and inventive stocks, advisors would. According to Wood, a recession may push creative tech stocks like the ones her company has made significant bets on into deep value territory. According to her, throughout the next 5 years, the adoption of new technology usually picks up speed during a slowdown because consumers and businesses become more inclined to modify their behavior patterns. The world was drastically and irrevocably changed by the coronavirus epidemic, indicating that stocks that are driven by innovation may prove to be profitable investments over the next 5 to 10 years. Wood came to represent the bull market that started in late March 2020 as central banks started injecting liquidity into the market to keep the financial crisis from escalating from the economic disaster brought on by COVID-related lockdowns. Wood's Florida-based ARK Invest made significant investments through a number of actively managed exchange-traded funds on disruptive technologies, from electric cars to cryptocurrencies. Yeah, she told the tens of thousands of ARK investors who watched the conversation that volatility isn't always a bad thing. I've never seen innovation on the market like it is now. Her opinions are expressed at a time when ARK Invest's flagship product, the ARK Innovation ETF, has already experienced a 20 loss this year. This follows a 24% decline in 2021, which preceded the fund's spectacular 150% rise in 2020. But in February, the ARK Innovation ETF's fortunes reversed following months of withdrawals, with $411.03 million coming into the flagship fund of ARK Invest. Cathie Wood stated earlier this year on CNBC's Capital Connection that the company has had significant inflows. ARK is an exchange-traded fund that is actively managed and allocates a minimum of 65 of its assets to companies that are associated with the disruptive innovation investment theme. Disruptive innovation, according to ARK, is the launch of a new technologically enabled good or service that has the potential to completely alter how society functions. Businesses that depend on or profit from the creation of novel goods or services, technical breakthroughs, and scientific investigations into DNA technology and the genomic revolution fall under this category. The website lists TV streamer Roku, virtual healthcare firm Teladoc, video communications platform Zoom, electric car maker Tesla, and cryptocurrency exchange Coinbase as some of the flagship fund's top holdings. Wood had previously said that the equities still offer a value as the company's sales and profitability increase, despite significant declines in high-growth companies like Zoom and Teladoc during the previous year. Given our predictions for growth in these new technologies, I believe we'll see some phenomenal returns. There have been other cautions raised regarding the potential for a market correction. The intraday swings have been amazing, according to Jim Paulson, chief financial strategist at the Luthold Group, an independent investment research company. Right now, a few important markets are in a bear market. Who knows where the stock market will ultimately crash, or how much longer the destruction caused by the roller coaster ride will last, because it has been so long since the previous correction. According to Christina Hooper, chief global market strategist at Invesco, a company that manages $1.05 trillion in assets, the chances are growing. The actions of the U.S. Federal Reserve to raise interest rates and reduce its balance sheet have only made the situation more likely. Credit Suisse's global chief investment officer, Michael Strobel, concurs with Wood that a crash is inevitable. He said that there are challenges for markets, especially the stock market, because we are in the middle of an interest rate hiking cycle. The dip mentality that pervaded the market prior to the Federal Reserve's massive intervention is no longer present. Now, an investor, Jeremy Grantham, who's long warned of the fourth super bubble of the previous century, recently issued a warning that the current decline in highly speculative equities may only be a precursor to a more severe and potentially imminent disaster. Wood is not alone, though, in believing that investors would profit from the current situation. Hedge fund manager Bill Ackman disclosed that he had invested $1.25 billion of his windfall from speculating on interest rate rises in Netflix following the streaming behemoth's dismal quarterly results last month. Many of our best opportunities have emerged when other investors with short-term time spans trash terrific organizations at values that look amazingly tempting when one has a long-term horizon, according to a letter Ackman wrote to investors. Although the current high rate of inflation technically indicates that the market is growing, investors are uneasy. On the other hand, an inefficient market correction caused by the Federal Reserve may really cause a market crash. Regarding whether this could be advantageous to investors, experts don't seem to be sure. One thing, though, is certain. Most of them concur with Cathie Wood that a market meltdown is imminent. Do you also think there will be a stock market crash? Do you think that investors may have an opportunity here, as Cathie Wood suggests? Please leave a comment below.